It's 1982. Ronald Reagan is president. The S&P 500 is at around 120. Eye of the Tiger is playing on the radio. Rocky III is playing in theaters. And Warren Buffett has just written his 1982 letter to shareholders. He starts his letter off by looking at return on equity. That is, operating earnings over beginning equity capital. That's how he measures a business's performance. Berkshire's return on equity was 10% in 1982 compared to 15% the year before, and quite a bit below the company's recent high of 19% in 1978. Although return on equity remains the major yardstick or measuring stick that he uses to look at most companies, for Berkshire it's become less relevant. That's because Berkshire's investing in companies it partially owns. Because of accounting rules, those earnings are not fully included in Berkshire's income statement. So let's talk about investing in the stock market. The beautiful thing about the stock market is that it's basically one big auction house for businesses. But instead of buying the companies listed on the stock market outright, most of the time, investors are buying partial stakes in those businesses. Now, Berkshire's used that auction arena to buy partial stakes in businesses at much more attractive valuations than it could if it were to buy 100% of those same businesses. Acquisition activity has been pretty eyebrow-raising in 1982. Warren Buffett feels that if the stock market was to rise much more above current levels, it would start to get really tough for Berkshire to make sensible acquisitions. He acknowledges that, although higher stock prices help short-term investment performance, they actually hurt long-term business performance, and he's starting to see early traces of this problem. You see, in any given year, stocks can outperform or underperform their underlying businesses. What does this mean? Well, if a company's earnings rise, say 10% in a year, and that company's share price rises 20%, then its stock has outperformed its business, right? Another way of saying this is that the company's PE ratio has increased. And that's what's happened to Geico in 1982. The valuation of Berkshire's investment in Geico is $208 million higher, which of course, seems good on the surface, but $79 million of that is due to a higher PE ratio. And that's been the case for the last 2 years for Geico. This is also happening at a time when profitability of the insurance industry is probably going to be terrible. The thing is, insurance is a commodity business. It's a business that sells an undifferentiated product. For that kind of business, the only time that decent profits can be made is when there's a lack of supply. For insurance, a lack of supply means a lack of insurers willing to do new business at the current prices. This is true for all commodity businesses. It's why all businesses try to differentiate themselves. They're all trying to avoid the brutal effects of competition. It really doesn't matter what the particular industry is. If it's a commodity business, profitability will improve for the industry under one condition: when the relationship between demand and supply improves. That's true for the producer of aluminium, of copper, corn, and yes, even for the provider of insurance. Now, Berkshire and Warren Buffett are well aware that their insurance business is a commodity business. And when supply eventually shrinks in the insurance industry, Berkshire plans to be there for all of the profitable business that will be available. Finally, Warren Buffett mentions the things he's looking for in potential acquisitions. A few things really stand out. He's looking for businesses that have already proven their earning power, or in his words, have demonstrated consistent earning power. Again, return on equity shows up. That's a metric that comes up tons of times in his letters. And finally, he wants them to be simple businesses. I think if we were to use a sports analogy, you could say he's looking for a proven player. He's not looking for someone up and coming with promise. He wants someone or some business that has delivered the goods year in, year out, year in, year out. In this case, delivering the goods means earning really nice returns on equity over a long period of time.